Hello and welcome to Quilterchieviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quiltercheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager based out of our Leeds office. And this week, I'm pleased to be joined by Richard Carter, our head of fixed interest research, and Ollie Creasey, head of property research. Good morning to you both. Richard, we've been waiting for a while for inflation to come down and then interest rates to start to come back down as well. Yet inflation seems to be stubbornly double the stated target. What is the outlook for interest rates and inflation for the rest of the year?
Yeah, I mean, it is correct. It has been a bit slow to come down, but actually, I think there is some grounds for optimism, Fraser, for the rest of the year, particularly in the UK. I mean, the kind of stubborn side has been the services side, kind of particularly wages, things like that. But actually, food and energy bills are coming down. And although we're still at 4% in the UK, if you believe the forecasters, and over the last couple of years they haven't covered themselves in glory, but if you believe the forecasters, we should be heading back towards 2% CPI within the next few months, which would be, I think, would be fantastic news. Actually, whether we'll stay there for very long depends on various factors. But if we do stay around 2%, at that point, the Bank of England might be a bit more amenable to interest rate cuts. So at the moment, market's pricing in first rate cut in August. As we know, we're supposedly in recession now, and you can make the argument if inflation is better behaved, then we could be cutting interest rates certainly in the summer, if not the spring.
Well, that would be good news. I think one of the things that might not be understood by all of our listeners is the effect that interest rates have on investments generally. Would you be able to walk us through that?
Probably not just our listeners. I think market analysts and central bankers as well. Sometimes, I mean, it doesn't always work the same way. But I mean, in general, big picture is higher interest rates means increase of cost of borrowing for governments and companies, tends to slow the economy. And if you're comparing various investments, it increases the sort of return you can get from cash and increases the return potentially on bonds, but and maybe makes equities a little bit less attractive at the margin. But it varies for different sectors, and actually banks tend to do quite well when interest rates are higher. So lower interest rates should be good on the whole. As I say, if it reduces the returns available on cash and helps the economy, lower interest rates should be good for investors, no question. Obviously, you've got to think sometimes, why are they cutting interest rates? Because if they're cutting interest rates because of bad news, cast your mind back to the financial crisis, lower interest rates may just be offsetting, some bad news in the rest of the economy. But at a margin, I think we'd all welcome lower interest rates as we go through the year.
Absolutely. Turning to politics, Richard, is there a sense of how the market might take a Conservative or Labour government, and any ideas of when the election will be?
I wish I knew. You look at the polls and by-elections and all the rest of it. The Tories are really struggling. You'd expect them to want to cling on to November. Really, is the most realistic outcome. I mean, there's still some speculation around May, but would Rishi Sunak vote to depart as Prime Minister later rather than earlier? We'll have to wait and see, but I suspect they'll cling on until November and hope for some good news and to turn up. I don't think markets are too concerned. I think they're more concerned about maybe what happens in the US and all the rest of it. The days of sort of Labour being extreme left have gone, certainly for now. So I think markets won't be too concerned about Labour getting in, and certainly that seems to be on the cards at the moment.
Well, that leads into the national debt. It seems to be astronomical, with the Office for National Statistics stating that public sector net debt stood at £2,686 billion as at the turn of the year. And the government borrowing 119 billion more in the last 9 months of 2023 alone. Is this level of borrowing sustainable?
Probably not, although you have to look at it in a wider context. The cost of dealing with COVID. We're not the only country in the world by any stretch of the imagination who has high levels of public debt and needs to do something to try and bring it down. That said, markets tend to worry about these things now and then. We did have the big warning shot, didn't we? What was that, a year or so ago when, seems probably longer now, when Liz Truss was in charge for those few brief period, and the sort of chaos over the mini budget. If you make the wrong noises and sort of believe you can get away with unlimited borrowing or sort of not really showing markets that you have a plan to reduce debt, then that can lead to some pretty nasty consequences. But at the moment, I think the government's fairly well regarded by markets and kind of generally has a sort of long-term plan to try and get debt down, albeit it always seems to be 4 or 5 years away when they're actually going to do it rather than now. But I think it was interesting that going back to the potential election, Labour are rowing back on some of their commitments to green spending. They can see that the public finances are not in a situation where you can sort of take liberties with tax and spending. So I think that, if anything, the whole Liz Truss debacle was a reminder to us and politicians that you can't take things for granted.
No, absolutely. Careful not to overstretch ourselves. Well, thank you, Richard. On that topic, Ollie, the mortgage market, I was reading, according to the Office for National Statistics, the average house price in the UK was £285,000 as at the end of 2023, a decline of £4,000 over the year. I know different metrics and different companies produce different statistics, but that's the official government one. Are things stabilising in the property market, or do we look like things will continue to be tough?
How long an answer do you want to this question, Fraser? You'll have to start making that that cut signal for me if it gets a bit boring for you. But you're absolutely right to highlight those metrics, and I think the adjective that you use depends a little bit on who you are. Those numbers are either frustrating or resilient or tough, depending on who you are in the housing market and whether you have a mortgage or not, and things like that. What I will say is, £4,000 over the course of the year, that's about a sort of 2% or so decline, which it's not hugely meaningful in the scheme of things, which is why I'm using words like tough and resilient and so on. Making house price forecasts is really, really hard, and I will put my hands up and say I'm not especially good at it. I'd like to think I'm good at a few other things, but this is not one of them. But my central thesis is that there's a lot of moving parts here. There's a lot of people with mortgages, and those mortgages are either recently sort of rebased to higher rates, or they will quite soon. But there's also a lot of homeowners who don't have a mortgage and are more or less insulated from interest rates and other things. There's a rising population and a general undersupply of property, but there's also difficulty getting finance and getting hold of a mortgage that supports a house purchase, especially in places like the Southeast. So what I would say is, I think things are probably going to stay relatively stable in terms of house prices. I really struggle to come up with an idea of a sort of a rationale as to why things might do a sort of minus 20% big sort of number. But I can foresee a scenario where they continue to sort of trickle downwards to that sort of handful of percent a year. And I do think things are going to remain a little bit challenging. I'm also not going to go out there and say plus 20% next year or anything like that, because I think there's a lot of just as many headwinds as there are tailwinds. If you want a more specific forecast, I think one of the things actually that we need to think quite hard about is what happens to volumes. I think prices may well stay relatively stable, but I think we'll probably see a low number of volume traded in this year, because fewer people are actually able to afford those prices if they do stay stable. So how's that for a prediction?
Very good. Yeah. You could be a politician. In our world, we tend to look at commercial property rather than residential property. How does that compare at the moment? Are prices rising? Are they falling? Is it harder or easier at the moment?
Yeah, it's a good question actually, Fraser. Thank you, and you're right to make the comparison between commercial and residential because they are quite different. They do behave quite differently. What I say to people is, commercial property has generally been governed by the head. Cold-hearted investment decisions being made there, whereas residential prices are a little bit more governed by the heart. And I don't mean that to sound dismissive or anything. I think that's sensible. Making a house price purchase is a very personal and a big decision for most people. But what we have seen in the last, let's say, 18 months, 2 years or so in commercial property is a very direct response to those interest rate rises that we've seen. Prices have fallen 25, 30% in some cases, rebased to reflect the economic outlook, and things are now moving on. Some sectors are seeing slight increases in values, not big. And there's others out there, office is a great example, which are still, I say, maybe reeling or struggling with the impact of things like working from home and trying to figure out what the new normal is in their particular sectors. So the real difference is that commercial property values have moved to reflect interest rates, and residential prices have generally, I wouldn't say ignored them, but stayed pretty buoyant despite them. So that's a potted history, I suppose, of the two sectors.
Yeah, absolutely. In your area, I guess there's a lot of different types of commercial properties. Do you notice differences between sectors? Are the yields different or risks?
Yeah, they are, and you can give me a yield number and I'll find you a property that trades at it more or less, unless it's below about 5%, which these days is a very rare beast. Again, you go back 2 years and 4% in any sector probably said you're buying a prime piece of real estate. These days, that number is probably more like 5 to 5.5. And again, that's the impact of interest rates. I think that's eminently reasonable and sensible. If anything, I'm a bit surprised that yield hasn't gone higher still, given that you've got the Bank of England at 5.25. 5 to 5.5 isn't especially you're not getting much of a return on that sort of investment, really. But yeah, look, each sector has its own sort of pros and cons and upsides and downsides. You look at 5.5, you can get that in sectors like real prime office still, where there's still huge demand in places like central London. You can get it in industrial properties, which is the Amazon and other online shopping plays, basically sort of boiled down into a single sector. But if you go into slightly more challenged areas like offices outside of prime London and shopping centres, other types of retailers, pretty much across the board, you could easily be looking at a yield of sort of 7, 8, maybe even 9% in the worst cases. So there's a lot of variance by sector, and there's a lot of variance by quality as well. So there's a whole host of different property types out there, and I'm not sure I can summarize them any better than that, really.
Well, I guess the follow-on question is to ask what your favorite types of commercial property are. And I wonder, reading the news and the hype in some of the financial sector, are there any opportunities in the AI sector at the moment for property?
Yeah, well, my favorite types of properties are the ones that go up in value, more or less. That's it in a nutshell again. And what sectors are those? I suppose you'll be curious to know. There's not many of them, and there's not many that are going up fast for sure. But I am generally focused in on those industrial type assets. The Amazon warehouses and the similar types are pretty strong in terms of their structural demand, and in particular the ones that sort of find themselves on the outskirts of suburban areas are of particular interest. It's very relatively easy to build a mega warehouse on the banks of the M1, but to build one in Surrey that can cater to people like me ordering Amazon packages every other week or so is a slightly more challenging prospect. Those things aren't quite so easy to build. So the demand there is really high, and the values are slowly but surely moving in the right direction. And you asking about AI, that shows that you've been reading the research that I put out from time to time, which I appreciate, because there are a few companies out there. And if you think about where AI lives, such as it does live anywhere, it lives in data centers, which is effectively a purpose-built industrial shed, really. It's an empty warehouse, but one with an enormous amount of power supply, very clean and chilled, as well as a lot of energy being put into the actual servers, a lot of energy being put into the cooling mechanisms as well, and then very well connected. So that means geographically well located. You get areas of West London and just outside of New York, for example, that cater to those major conurbations. And I suppose you could technically build them anywhere as long as you've got really good fiber optic cables and so on connecting you to the places you want to be. But latency is a huge factor in the sector in general. Now, there are a few companies out there that specialize in the data center sector. They don't all feed specifically into AI, but people like Netflix have got an awful lot of data center requirements as well. Amazon Cloud, Microsoft Azure, those sort of names all use these as well as AI. And so there's a few US REITs out there that specialize, and there's some of the larger companies out there as well. And I wouldn't put the names out there as an investment recommendation as such right now, but companies like Equinix and Digital Realty are names that if you are thinking of AI's an interesting idea and data centers sound interesting as well, they're the ones you should take a closer look at. I think that's about all I need to say really on AI. It's a big theme in our sector, just as it is in many others.
Yes, they're coming for our jobs, apparently. Well, thank you both for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials. And you can also tag us at Quiltercheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We would love to hear your questions. And that's it for today. So thank you, Richard and Ollie, for your time today, and all of you for listening. See you next time.